is there potential for a 2008? Absolutely. I think that's the biggest issue we have right now. I think people are stuck on the mindset that the equity market can never fade, and I think it can. I think you've entered into an atmosphere where you want to be looking to sell rallies instead of buying breaks.
The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even $1 billion gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit crushthestreet.com/gold.
Hello, everyone, and welcome into crushthestreet.com. My name's Kenneth Amaduri, and I'm joined today with Steve Erdman. He's the president of International Futures Group. He's a market trader. Was a member of both the CBOT and the CME. He's a co-founder of EFG Group, and he's got 35 years of experience working with the markets, following the economy. And we're going to have a great conversation today. His website is ifgfutures.com. Steve, thanks so much for joining me.
Thanks for having me, Kenneth. Really appreciate it.
Steve, there's been a lot of turmoil in the markets, and in your extensive career, is what we are seeing today anything like you've seen in the past working in the financial industry?
It's interesting you asked that because I've seen a few comments in the last couple of days that are referencing 1987. And in 1987, I was managing our desk on the mercantile floor. We had a similar situation where the equity market basically melted down, and the equity indexes really didn't have any value, and it was a very unsettling experience for me being on the floor, and we tried our best to protect our brokerage base and their clients from any adversity. But what I remember the most is calling up my now partner, Tom Fritz, over at the Board of Trade, telling him to get all of our clients out of their grain contracts because the world was coming unglued. He started laughing at me and told me to step back because this, in the short term, would be bearish to grains, but in the long term, it would prove to be beneficial. And it really was. In 87, it didn't hurt things. In 1988, we had a drought in the central U.S. that propelled grain prices higher. But, if you look at where we've been in the last 10 years in terms of the commodities and how since probably the middle of 2007, how the indexes, like the Bloomberg index, has been peaked and going straight down, and commodity prices, to a general degree, have been on the defensive. It would seem to me now that it's that opportunity may have changed here in the near term. You may want to be looking more at commodities, and I think that the market being unsettled in the stock market, it's showing people that the Fed may have done all of the stimulation that they are going to do in the near term, and they've decided to raise rates. I mean, 0.25% doesn't seem like much to people, but we've been on the same course for the last 8 years, and that's
it's a big deal at 19 trillion, right?
You betcha, absolutely. It's a big deal just for the U.S. debt and for the world debt.
World debt.
Yeah, I've seen estimates that are unbelievable, and this stimulus has really affected the market. We've had a lot of the developing countries that take on debt and done expansion. It's going to be interesting to see if they're going to be able to sustain it, and some of the impact that this is going to have as these capital flows change.
Steve, talking about the last 10 years, is it possible that we could have another 2008 type crisis? And I guess the argument would be that the banks have been stricter with their lending, and they've had more rules. And you even hear talking heads say that it's unlikely that we would have another 2008 type situation because the banks have been stricter and there's more quote unquote fundamentals supporting this economy. Any thoughts on this?
Well, I think the intent of the Fed keeping short-term rates at zero has been to recapitalize the banks, and obviously that's worked. I think the banking industry in the U.S. is in much better shape than in Europe, for example. I think there's specific instances where the talking heads, and you're seeing more news blurbs come out each day about some of the banks and some of their exposure and how they're going to be able to handle this exposure. And I think that's been a positive for us, but in the same breath, I think it's created situations like we have in China right now where you're pulling capital offshore for return. There's carry trades being created just because they have the ability for this money and they're looking for alpha. They're moving that capital into any situation that can give them return. So is there potential for a 2008? Absolutely. I think that's the biggest issue we have right now. I think people are stuck on the mindset that the equity market can never fade, and I think it can. I think you've entered into an atmosphere where you want to be looking to sell rallies instead of buying breaks, and we do a lot of technical work here. My two partners and I, we've been doing this for combined over 120 years between the three of us, and we're mindful of these longer term trends and the implications when these trends change. And I think that's what the public needs to be alerted to.
Steve, when it comes to currencies, if you don't mind me just touching on this, what do you expect potentially if we do see ongoing global market sell-offs for the U.S. dollar?
I've been suspect of the dollar strength for a while now, and I think technically when you look at some of the longer term charts, we put in a big double top in the dollar index. I think if it does start to break down, it's going to have some exposure in terms of what the targets would be. We're a very math-oriented asset class now because of all the algorithmic trading and the computerized trading that's entered our markets in the last 10 or 15 years. But to me, when you look at a dollar index chart and you see the highs that we made in 2015 and in March and April, and the fact that we retested those highs after a break, we retested those highs back in December this past year. I think you want to be very, very careful of any exposure that you have in the dollar, because I think if the market starts to break down, technically, and I'm just talking purely math now, some of the measurements would measure the dollar index down to levels, for example, of in the mid-80s, where we were back in 2013. And that would take some doing, and we're keen on waiting for confirmation for anything that's developing like this. But I'm very cautious about the dollar right now, and I think it's vulnerable.
So, Steve, and you just said from a technical perspective, but what about from a fundamental perspective? Is it possible that in a global market sell-off, people continue to flood into U.S. dollars and the dollar gets stronger throughout 2016?
Absolutely. But for me as a technician, Kenneth, I'd need to see a weekly close in the dollar index above 100.60, because that's the high that we made back in December. So for the market to show me enough intrinsic strength, so in other words, when we look at things technically, we're acknowledging that we're not sure how much of all the fundamental information has been digested by the market. And we try not to outguess the market. We try to let the market give us the direction of which way it wants to go. But dollar strength or weakness is a relative thing compared to all the other currencies in the world. And it's been strong because of people's tendency to go to a safe haven, along with precious metals. And I think, if the Fed continues to raise short-term rates, that's obviously going to give the dollar strength. But I think that's a question mark right now, whether the Fed's going to continue its path of raising short-term rates, whatever the increments are.
Yeah, no, I agree with you and all that you said right there. You touched on it briefly, and even just now you mentioned commodities. So let's start first with agriculture. You've got a long history of working heavily, trading agriculture commodities. So what I wanted to just touch on here and ask you about is ag, the ag sector, a safe haven industry for people who are concerned about a global market crisis?
Well, I think the ag sector is very much supply-demand oriented, and I think you've got to go back to price whenever you're looking at an abundance of supply or supply tightness. And right now, for the last couple of years specifically, we've had an abundance of grain in the world, and I think we've got one of the larger world-ending stocks of coarse grains that we've seen in numerous years right now. Wheat supplies are plentiful. The U.S. producer, for example, has produced over a 13 billion bushel crop for 2 consecutive years. But that dynamic between supply and demand, if that changes, if the pile of grain left over at the end of the day starts to shrink, price starts to react to that. And price has been under relative pressure because we have had an abundance. And the main thing to focus on for anybody that's watching the ag sector is whether that pile starts to shrink or whether it continues to grow.
So,
and
Steve,
go ahead.
No, I was just going to ask, is there any correlation between the ag sector and dollar strength / dollar weakness?
Absolutely. The strength of the dollar makes our products more expensive overseas, and it has a dramatic impact on our export. Right now, for example, I think the export registrations out of South America since the middle of December have gone up to 11.5 million metric tons, and that's a 180-day license. So South America is going to continue to be a tough competitor for us in the export trade. Even though ocean freight is relatively cheap, the uncertainty of China's economy and how much they're going to continue to buy in our markets is yet to be seen. So the dollar strength hurts the ag sector, absolutely.
Steve, moving over to precious metals, what are your thoughts at the moment with the current environment and precious metals as a trade or long-term investment?
I think long-term, I think it's you got to realize where, for example, gold has been and what the possibilities are for gold. And to me, I think the gold market is a long-term asset accumulation, or as my friend Jim Comiskey likes to say, stacking the metals is a good thing. And I agree with that because, quite frankly, we've broken from the highs we made back in 2011 at or around $1,800 an ounce. The gold market's broken from that price level over the last 6 years down to the fourth quarter of last year. We traded below 1,050. So for that reason alone, I think people should be looking to own metals and on a relative basis. And that's, again, I'll go back to looking at a stock market that's on a tear, that's rallied from 6,500 6, 7, 8 years ago to current levels over 18,000, some of the highs we achieved last year. So I think it's a good idea to keep those relative values in mind and to trade accordingly.
You know, Steve, you talking right there kind of it reminded me about people's psychology. You know, people's most recent experience, not talking about the crash that we are seeing right now, is that stocks have been going up for the last few years, and they're more comfortable buying stocks at these prices than precious metals, which have been going down over the last 5 years, because that is their most recent experience. Although we always say buy when there's blood in the streets and, sell when there's a bubble. It's really, when it's all said and done, to actually do that is very, very difficult. Any thoughts on just the investment mentality to overcome that and be able to make the right decisions when you need to do it?
Well, I think people are more comfortable with the stock and the equity markets because it's more forgiving. And I think that what lulls people into a false sense of security about stocks. If you liked it at 17,000, you're going to love it at 15,000, and that's dangerous to me, because in our industry, in the commodity futures industry, the market, you're either working with the market or working against the market. And if you're working against the market or your investment isn't working, you're going to get margin calls. So it's something that's going to sit there and hit you right in the face about whether you're right or not. And it makes you re-examine your portfolio, if not on a daily basis, even on a moment-to-moment basis. And I think that is a good thing given the current environment. But I think people don't look at the scale of where we've been when they look at the equity market. If you look at the lows that we made and where the market has come since the March of 2009, when we made our lows below 6,500, and again, the fact that we've rallied to 18,000, this is due to the Fed's program, and they acknowledge us when they created this zero interest rate policy, that they wanted to drive capital into the equity market, because that is the U.S. consumer's gauge of the health of the U.S. economy. So if the stock market is doing good, happy days are here again, and that's really what we've done since 2009. It's worked. The policy's worked. I think it's created some bubbles in different places, but I think now that policy admittedly has come to an end, and I think people need to be mindful of that.
Yeah, and we know that the government is very dependent on stock market growth, because we know that when stocks fall, that they lose a very, very large amount of tax revenue. So we know it's in their interest to keep it propped up and going. Steve, just shifting gears slightly, maybe you can give us a little idea on what it's like to trade futures for the average person that doesn't.
Well, I think it is intimidating, and I think that's a good thing, that it is intimidating to trade futures, because you have so much leverage in the futures market, which equates to so much risk. And I can't say enough about the risk that people incur if they choose to come in and open a commodity account. That's why I think it's critically important that you have a broker that you're working with, because the full service broker, it's not like trading online. I've seen and heard of a lot of people getting themselves in trouble because they don't realize the leverage that they have by trading their own account and getting into situations where, as I said, you've got to monitor your account not just daily, but sometimes, given the volatility in the markets, intraday from minute to minute. So it's critically important to work with someone you trust and that you can use as a sounding board that can help you analyze different opportunities or different risks in the market. But commodity futures, I think, even in the last 25 years since I've been in the business, have become more and more accepted as a good part of your portfolio for 8 to 12% of any investment portfolio. The diversity it brings into an investment portfolio.
So trading futures, is it fair to say it's more of an income strategy approach or long-term investment?
Well, I think it depends on how you utilize the futures business. I don't think it's necessarily an income producing. Each individual is going to have a different goal for their investment portfolio. I think it's good to try to hedge any type of investments you might have in equities, for example, or fixed income. I was brought up in the grain business, so what I learned 35 years ago is hedging, and that's taking an equal and opposite position in anything you have in the cash market. And I think that's where people are not using the futures market where they could to their best advantage at this point, because again, we'll go back to the equity market, how it's tripled or almost tripled in value in the last 6 or 7 years, how you may want to take some protection without disturbing your portfolio with your stockbroker. You may want to try to lay off some of that risk if the market does continue to drop. I mean, today, the stock market at this point in time, it's about late morning in Chicago, but the stock market is rallying today. I think you just need to be mindful of the exposure you might be taking on by sticking and staying in the stock market instead of considering other alternatives.
So, Steve, in conclusion, what are your final thoughts regarding the current economy and how people should be approaching the markets in 2016?
Well, again, I'll go back to the Bloomberg index and how that's been on the defensive since 2008, actually 2007, mid-2007, I believe. So that's a pretty good indicator of the commodity markets in general. And I saw Jim Rogers. I was fortunate enough to be at a seminar for Jim Rogers back in the early 2000s. And at that point, since 1998, I think Jim was a commodity market bull. And I think he looked for a 10 to 15 year rally, and we had one. We had a significant rally. He was right on the money. And then I think he even acknowledged that the market wouldn't necessarily go straight up, but we'd see some corrections. I believe we've seen that correction in the commodity markets. I think the market's offering opportunity, whether you're looking at gold or silver or copper or the grain complex or meats. I think there's opportunity there. But again, I'd encourage your listening public to get involved with a broker that you know and trust, so you can also address the risks that are inherent in the commodity futures market. But I think there's opportunity here.
Steve, if the audience would like to reach out to you and visit your website, where would they go and what would they find?
They can call us toll-free at 1-800-786-4475. Our toll number is 312-384-1195. Our website is www.ifgfutures.com. We do trend following posts. We do webinars on our website. We'd love to invite anybody to come and participate in our webinars. You can go to the website, and it's pretty straightforward how you get involved and view the webinars. We do a couple of those a week. We have different pieces that we produce that are also available on the website. So contact us and we can give you more details.
Steve, thanks so much for coming on the show and just sharing your extensive career and knowledge with us here at crushthestreet.com.
It's my pleasure, Kenneth. Thanks for having me.
Absolutely. We'll definitely have you on again in the near future.
I appreciate it. Look forward to it.